Hello and welcome to Earnings Echo. We put together the most important information about Uber technologies.
Well, diving right in, we're looking at a clear divergence between top-line growth and bottom-line efficiency in these Q4 2025 results.
A divergence. How so?
Revenue came in at $14.37 billion. That actually beat the consensus, which was around $14.32 billion, so a slight beat there.
Okay, that sounds positive.
But the adjusted earnings per share landed at 71 cents. That's a clear miss against the analyst consensus of Necken's 80 cents.
So a distinct profit miss despite the revenue beat. Is the guidance for Q1 2026 signaling any kind of recovery or more of the same?
It's signaling continued pressure. The outlook projects gross bookings of 52.0 or $53.5 billion.
And then the EPS.
That's the critical part. Non-GAAP EPS guidance is set at 75.72 cents. That is, notably below the market's expectation of 75 cents.
So an earnings miss now and light guidance for the next quarter. How aggressively did the market price in these yellow flags?
Immediately. Shares fell between 6% and 8% right after the release.
Makes sense. Investors are clearly reacting to that combination of the miss, the weak outlook, and probably some concerns over spending.
Exactly.
Okay, let's analyze the operational drivers. Demand appears to be at a record high, yet profitability is squeezing. What is actually causing this margin degradation?
It's a classic volume versus margin dynamic. Volume is definitely robust. Trips grew 22% year over year to 3.8 billion.
And user growth.
Also strong. Monthly active platform consumers reached 202 million. That's up 18%. But the pressure is coming from the product mix.
You mean the push for those lower-cost tiered rides?
Correct. The strategic push for affordable options, things like the shared rides, it successfully boosted volume, but it squeezed margins more than Wall Street models were anticipating.
And I saw something about taxes.
Yes, another headwind. The effective tax rate for 2026 is expected to rise to between 22 and 25%. That will directly impact net income going forward.
Understood. And looking at the business segments, is this growth distributed evenly across the company?
No, delivery is accelerating faster than the core mobility business. Delivery gross bookings were up 26% year over year.
That's a big number.
It is. It's just past a $100 billion run rate. That outpaced mobility, which grew at 20%. And freight is still a drag on the portfolio. It was basically flat at down 1%.
Okay, let's shift to the earnings call. The management tone seemed, I'd say, largely defensive, especially around the autonomous vehicle strategy.
It really did. Management focused heavily on countering what they called misconceptions about competitors like Tesla and Waymo.
Did they provide any data to back that up?
They did. CEO Dara Khosrowshahi gave a specific data point from their hybrid network in Austin and Atlanta. He said they're seeing about 30% higher vehicle utilization.
30%.
And roughly 25% lower ETAs than competitors, specifically because they combine AVs with human drivers.
But this whole AV transition is incredibly capital intensive, and we have a major governance change happening at the same time.
That's a key risk factor everyone is watching. CFO Prashanth Mahendra-Rajah is stepping down.
And Balaji Krishnamurthy is coming in.
Right. And losing a CFO during such an expensive strategic pivot, it creates anxiety around capital discipline.
There was also a technical accounting note about the UK market. Can you clarify the impact there?
Yes. So the business model outside of London is shifting from merchant to agency. This will optically, and I stress optically, lower reported revenue margins by about 350 basis points in 2026.
But it doesn't actually hurt the bottom line.
Management was clear that it's neutral to actual profit. It will just distort the margin percentages you see on the income statement.
So to synthesize this whole investment narrative, Uber is generating a ton of, $9.8 billion in free cash flow.
That's right.
But it really appears to be undergoing a valuation reset.
That is the echo for investors today. The company, frankly, was priced for perfection. So the slight profit miss, combined with rising tax rates and these fears of a heavy AV CapEx cycle, it just triggered a sell-off despite those record volumes.
So the market is reassessing the cost of Uber's pivot to becoming an AV facilitator.
Precisely. It's no longer just about rideshare growth. It's about the cost of that future.
And finally, the obligatory disclaimer. All content in Earnings Echo is AI-generated information and does not constitute investment advice. Investing involves risks. We assume no liability for your investment decisions. Do your own research before taking action. Numbers checked, portfolio prepped. Catch you again soon.